Thousands of investors bought villas in Bali and expecting 20% returns. In 2026, they even cannot fill a single weekend. Today, I'm sitting down with a hotel investment advisor who have run portfolios in PricewaterhouseCoopers and have been taught the students in New York University in quantum analysis for the real estate. And we will go into break down what went wrong and where is the seriously money actually moving right now. I'm Oleg, and I have been building and investing in businesses over the 15 years. And in real estate investment, I have been learned one rule in a hard way. What our crowd is buying today, market will punish tomorrow. 2023. Every real estate agent on Instagram is screaming, buy off plans, get 20% annually, beautiful charts, beautiful promises. And today we will check what's going wrong and we will lean on the numbers and not on the promises. With me today, Росс Wuds, the guy with more than 40 years of experience in the real estate investments, the guy who was working with PricewaterhouseCoopers and who was studying the real estate investments and quantitative analysis, right?
That's great.
For the real estate in New York University. Hi, Ross. It's a pleasure to meet you.
Thanks.
And thank you so much for joining us today and invite us in your beautiful office here in Bali.
Thank you.
Today, guys, we will talk about the real estate investments in Indonesia, real estate investments in Bali, because we meet with Ross here in Bali and we are right now on the Sunset Road in his office. I know that Ross is managing the big portfolios for the wealth management funds, for the private equity funds, and so on. I will not gonna talk too much, right? I will give word to you. Could you please tell to our audience a little bit more about yourself, what you're doing, what kind of experience you have, and a little bit more about your journey?
Thank you very much. Well, I've been involved in primarily hospitality, hotels, resorts, theme parks and things of entertainment type attractions for about 40 years. I was a partner in the firm Horwath International, which was and still is the largest hospitality consulting group in the world. And so I spent some time with Prudential, and then I joined PricewaterhouseCoopers in their office in New York, providing advisory services to real estate investors, developers, hotel operators. And then in about 2006, I set up my own consulting practice, providing services to primarily private equity groups in North America and real estate investment trusts.
And you mentioned when we just met that you're expert in quantitative analysis, right?
Yes. That's what I've specialized in.
Could you explain a little bit more simpler, what is that? In simple words, if you can.
Well, I guess we used statistics to assist us in making decisions. Mm-hmm. You know, it's very difficult in business to make decisions without quantitative data. I guess there are some people who do. They like the color of something or like some aesthetic part of a real estate, but most people are wanting to know, the cost of it, the operations, and what type of return. And so what I have attempted to do in my career is to quantify risk. Most people will have some understanding of what a rate of return is. If I said a 10% ROI, you'd understand what I was talking about. If I said a 10% return, it may mean an internal rate of return, which is a little bit different from a return on investment. But in terms of risk, there's no two people on the face of the earth that have the same view of risk. They come to deals because of experience. They may have heard that someone lost money or made a lot of money. And so we spend an enormous amount of time trying to understand risk. And clearly, we seek legal advice. We seek structural engineering advice. We might be having interior designers. We have all the other people here in Indonesia, the notaries, who are attempting to provide us some understanding of the risk that may be associated with investments. But unless you quantify it, it's very difficult to talk about risk-adjusted returns. And so that's what I've specialised in, trying to be more scientific, if I can use that term, about risk, quantifying it. And if people don't speak the language of probability, then in my view, they're not talking about risk.
So in other words, in simple words, you give into the investor range from how much he can get, right, to how much he can get. For example, from 11 or from 8 up to 16%.
Right. In a capital market, a rate of return is a function of risk.
Yeah.
The more risk you take,
The more returns you get, right?
well, they're not mandated or they're not known, but you would assume that the higher the risk, the higher the return. You're not guaranteed that you're going to get the return, but you should. And so if there's high risk, high return, low risk, low return, and that is so fundamental. It's fundamental to the real estate industry and to most capital organisations that if you quantify risk, you have a better understanding of the return that you should expect. I use the term, along with a lot of other people who are involved in the capital markets in relation to real estate. The question is, what is your appetite for risk? But if you ask someone who was less experienced in real estate, you'd say, what sort of returns do you want? Most people say, I want the most returns. Well, the most returns may be the riskiest returns. So that people need to understand, their appetite for risk. Are they really risk takers? Are they prepared to lose 20 or 30% of an investment? And there are some people who say, no. So I think risk is underestimated in the mechanics of real estate deals.
Totally agree with you, and that will be our next topic. The one last question about that topic I would like to ask. Could you please let me know a little bit more behind the scenes, because you're working with large investment firms, and what is their expectations from the real estate investments? How would they expect? Of course, I understand that each investor expect as much returns as he can get,
yes.
Right? But there is probably all of them more conservative than individuals who are investing here in Bali in separate villas.
Right.
So what is the difference between two of those audiences? Could you share your
Well, if we look at family-owned, I guess the major offshore investors are what I'd call the family office market,
Yeah.
and from Hong Kong and Singapore and also from Australia. They have a longer-term perspective than a lot of private equity groups. Private equity groups in the main, particularly in hospitality, are looking, if they're looking at an opportunistic investment, they may be looking at for 3 or 4 years. If they're looking at value add, maybe 4 or 5, and if they're looking at core, there may be a 10, 12-year investment horizon. Offshore investors in the family office market are certainly here in Indonesia, and not so much private equity. Private equity has issues in relation to transparency and liquidity. And I guess there are private investors as well. People are looking at smaller eco resorts and things of that nature, but not main private equity groups.
Yeah, but what if when we're talking about numbers?
Yes, in terms of rates of return.
Yeah.
Well, most offshore investors, when you invest in another country, many investors treat that as opportunistic.
Yeah.
In other words, they would expect an opportunistic rate of return to invest in a country other than their own. And so an opportunistic return is, better than 20%, an IRR of 20%. So it could be 18, 16, 18, that sort of thing. So that's because there's just many more risks associated with foreign currency exchange, the political climate, regulations, and all the other issues associated with investing in an offshore country.
Yeah, and actually you already touched that point and that topic that I would like to discuss next. And that's the topic about that most of the investors expect 20% returns on their investments. ROI, as you mentioned, right? And they don't think about the risk, about all of that stuff, about the market and so on, and that the situation in the world can change. And of course, there is a lot of other things that they're not calculated. Right now, I see that a lot of people, they expect more than 20% of returns from their investments from the rent in Bali. But right now, they cannot rent out their villas.
Right.
And I know that there is a legal perspective, and we will talk about that a little bit later.
Right.
But right now, I'm curious about why that happens, why they not meet their expectations, and where is the problem and the issue on the market from your perspective as an expert.
Right. Well, when I see people what I'd call either naive or not experienced real estate investors, and they're investing in an offshore country, and they're looking at offers of 20%, there's this expectation that they're going to achieve a 20%. But if you were to say to them, what's the probability you're going to earn less than 20%?
Yeah.
They'd say, and you say, well, there's a probability because the 20% is essentially what we'd call it's a deterministic rate of return. It's 1 point.
Right.
It's a point estimate, but there's a probability you might do better or probability you might do worse. And so if I see people buying investments potentially on a 20% rate of return, I feel like saying to them, wow, you've got a great appetite for risk. Mm-hmm. So the fact that some of these people aren't or having difficulty renting their properties today, I mean, given what's happening in the Middle East, that could well be a bigger issue for all of us. But it comes with the territory. If you're expecting 20%, you hope you don't have downside. But now if you bought something with 8%, mm-hmm. potentially there may be a less probability you'll earn less than 8%. 8%. Yeah, so it's a question of risk return. You can't, but the problem is that people look at returns and risk sort of goes out the back door. They have a superficial understanding of risk, and mm-hmm. they really need and I think I said to you a little while ago that risk is about probabilities. And if someone talks to me about risk, the questions I ask are, what is the probability you're going to earn less than on your 18% investment? What's the probability it's going to be less than 10%? Now if they said, oh, that's a good question. Gee, I would hope no more than 5%, but at least they've started to understand the spread.
Yeah, what is your vision of the current situation on the market? What is the fair returns on investments for the people at this point and in this moment on the market?
What happened here in Bali, prior to COVID, I mean, there were a lot of investments, people were selling villas. COVID was really a significant structural change. Everyone thought that we'd get back to normal. Well, the normality that we saw before COVID really hasn't come back in the same form.
Yeah.
And enormous growth, 2022, 2023, 24. Fusion of capital, and a lot of people have been excited by what was happening. Now, is it a structural change or a cyclical change? I'm a great believer in cycles. And there are very, very few markets. In fact, I can't name any market in the world that hasn't gone through cycles. There are cycles of capital, there's cycles of supply and demand, there's cycles of investor sentiment. All these cycles are intersecting. So I think that we're in a softening period now. Clearly, if we look at what happened the last 6 months of 2025, it started to slow up. And I think it'll be 2 or 3 years before we get back to potentially the hiatus of the last few years.
But that's absolutely okay, right?
Yeah. And see, people, if you had bought at the top of the market, then potentially you've got an asset that may depreciate. Now, to what extent will it depreciate? So you bought a villa for $500,000. It may not be worth $500,000 now, but the question is, I hope it will be worth more than $450,000 or $400,000. Problems for some people are opportunities for others, because people there will be investors who will say, I think the market is bottoming, is about to bottom. Rates have come off by 25%. This is the time to buy. And so you'll find what I call momentum investors. When they see, some people get in before the trough, so they may be early investors, and then other people will get in as momentum investors. They say the worst is behind us, we're going to get back into the market. And so people need to understand there are cycles, and if you buy any form of real estate and you don't take into account cycles of whether it be supply demand, maybe sentiment, it may be the cost of capital, then you're going to take a naive approach to investment in real estate.
Yeah, so I have 2 questions to clarify, right, and to show to our audience in a simple terms. Yeah. You mentioned that what's happening right now on the market since last 6 months.
Yes.
And could you count what's happening on the market, what has been changed on the market, and why the market right now is on the correction stage?
Well, I think I think
just simple 1, 2, 3.
Yeah. Well, I think oversupply. I mean, there's obviously a lot of product that's come onto the marketplace in a short space of time. The market has softened. There are less people looking for these quick buys. So I think oversupply. The other thing I think is that the quality of the product. When you've got a hot market, a lot of people will become involved in that market. Inexperienced, very experienced, and I think you're seeing a wash up between a lot of villas that probably aren't well developed as they could be, and others. And so some people will have issues in trying to distinguish why that particular villa should be worth less than that villa. And so I think there's going to be there's some issues in relation to customer perceptions and buyer perceptions. And I think the third thing is that the government, I think, is now much more involved. They're concerned about. There's been a lot of illegal activities in terms of development in rice fields and inappropriate zoning and inappropriate structures, whether or not you're privately owning a villa or you're going to be leasing it, renting it through.
And the management also, right?
The management, yeah. So that, I think there's a combination of things that have happened in the last...
So if to summarize that point, so there is a lot of big things that people need to understand. First, sheet quality of the product.
Yes.
Is come a lot.
Yeah.
A lot of supply, but demand is the same.
Yes.
So there is not enough of like people who will go rent it out.
Right.
That's why occupancy rate is dropping down, and also the prices is dropping down. So the investors who invested before cannot get those returns that they expect.
Right.
Okay. The third thing is the legal issues, as we mentioned.
Yes.
And rules right now become more strict.
Yes.
And could you please let us a little bit know about those rules? Are you familiar with them?
Well, I'm not. In fact, my colleague here at 70 Stones, Indonesia, is really the person. All I can say is that there's been a lot of illegality that have taken place. People have been doing things outside the law. Some people probably did that consciously, and others were mistaken. And I think the government is attempting to come to terms with all of those issues. Now, in terms of the specific issues, I would prefer not to attempt to answer that because I'm not a specialist. I essentially look at market financial and then seek legal counsel. So, but it's obviously an issue, and I mean I know the government and
how do you think right now an Indonesian government already solved those issues by making the regulations more strict?
Yeah, well, I think it's a first step. The ongoing resilience of the government and governance is critically important. I mean, people talk about over-tourism and they talk about congestion and traffic and pollution, and at the end of the day, we need to have a more accountable government, whether it be the state, provincial, or national government. And I think there's a willingness to hear these departments out. I think they're wanting to do the right thing. It's not easy. It's not complex. I mean, it's complex. It's not so easy. So I think they're moving in the right direction.
So 20% was never a return. It was a marketing number. It's when institutional money quietly steps in. In the next episode, Ross breaks down the 3 Bali zones still performing in 2026 and the 3 rules professional investors use before they sign a single check. The catch? That playbook was built for funds with $500,000 per deal. That's exactly why we built Binaryx. Fractional ownership in vetted Bali properties from $500, Wyoming DAO LLC structure, on-chain transparency, and daily rental income to your wallet. The same asset class, without the $500,000 ticket. Link in description. See you in part 2.